Warren Buffett, the Oracle of Omaha, a legend in investing, is currently sitting on a pile of cash, $147 billion to be exact. This is unheard of, even for him. What does it mean? Is he predicting a crash? Or is he waiting for the perfect moment to strike? Buffett's company, Berkshire Hathaway, is a behemoth, owning everything from railroads to insurance companies to candy brands. Its cash reserves are a closely watched indicator, offering a glimpse into Buffett's thinking. The sheer size of Buffett's cash pile has fueled speculation. Some market analysts see it as a red flag. They point to his past behavior, noting that Buffett has often built up cash reserves before major market downturns. In 2008, for example, Berkshire Hathaway was sitting on a mountain of cash and was then able to capitalize on the financial crisis, making strategic investments in companies like Goldman Sachs and General Electric. These analysts argue that the current economic climate is ripe for a correction, citing rising inflation, geopolitical instability, and a potential recession. They believe Buffett is positioning himself to weather the storm and wants to emerge stronger when the dust settles. Berkshire Hathaway's cash reserves have been steadily growing in recent years, reaching a record high in 2023. This trend has accelerated, becoming a source of fascination for investors and analysts alike. The sheer magnitude of the sum is difficult to comprehend. It's more than the GDP of many countries. This unprecedented cash position reflects Buffett's disciplined approach to investing. He is not one to chase returns, preferring to wait for the right opportunity. He often quotes his mentor, Benjamin Graham, "The stock market is a device for transferring money from the impatient to the patient." This philosophy has served him well over the decades, making him one of the wealthiest individuals on the planet. Despite some questioning whether Buffett is being too cautious and missing out on potential gains, especially with the strong performance of the stock market in recent years, Buffett remains unfazed by these criticisms. He sticks to his principles, believing that patience is a virtue, especially in investing. Despite the massive cash reserves, Berkshire Hathaway has not been entirely inactive. The company has made several significant acquisitions in recent years. It bought Precision Castparts, an industrial conglomerate, for $37 billion in 2016, and acquired Allegheny Corporation, an insurance company, for $11.6 billion in 2022. These deals demonstrate that Buffett is not simply hoarding cash, he is willing to deploy it when he sees value. The acquisitions also provide insight into Buffett's current investment thinking. Both Precision Castparts and Allegheny Corporation are considered to be well-managed companies with strong fundamentals, operating in industries that Buffett understands well. This suggests that he is focusing on quality over quantity, not interested in speculative bets, preferring to invest in companies with a proven track record. These acquisitions suggest that Buffett is not necessarily predicting a crash. He is simply being selective, waiting for the right opportunities to deploy his capital. This cautious approach is in line with his long-standing investment philosophy, emphasizing patience, discipline, and a focus on intrinsic value. Section 5. Market Signals and Economic Indicators. The current economic landscape is complex and uncertain. Inflation is at a multi-decade high, interest rates are rising, and geopolitical tensions are escalating. These factors are weighing on investor sentiment and creating volatility in the markets. In this environment, it is understandable why some analysts believe that a correction is imminent. Certain economic indicators are flashing warning signs. The yield curve, for example, has inverted, meaning that short-term interest rates are higher than long-term rates, often seen as a precursor to a recession. Additionally, consumer confidence has been declining, suggesting that consumers are becoming more cautious about their spending, which could lead to a slowdown in economic activity. However, other indicators paint a more optimistic picture. The unemployment rate is low, and corporate earnings are strong. These factors suggest that the economy is still relatively healthy. This mixed bag of economic data makes it difficult to predict the future with any certainty. It is possible that the economy could experience a soft landing, meaning that inflation would moderate without a significant downturn. Section 6. Historical Parallels. Buffett's moves in past crises. Warren Buffett has a long and successful track record of navigating market crises. He has consistently outperformed the market during times of turmoil, due in part to his disciplined investment approach. He is not afraid to go against the grain, willing to buy when others are selling. During the 2008 financial crisis, for example, Buffett made a series of bold investments. He invested $5 billion in Goldman Sachs and put $3 billion into General Electric. These investments were made at a time when most investors were panicking and fleeing the markets. Buffett saw an opportunity to buy high-quality assets at discounted prices. These bets paid off handsomely in the long run, Buffett's actions during the 2008 crisis demonstrate his contrarian nature. He is not swayed by market sentiment, focuses on intrinsic value, and is willing to be patient, waiting for the right opportunity to strike. This approach has served him well over the decades, making him one of the most successful investors of all time. Section 7. Contrarian Investing, Buffett's Hallmark. Contrarian investing is a hallmark of Warren Buffett's investment philosophy. It involves going against the prevailing market sentiment, buying when others are selling and selling when others are buying. This approach requires a high degree of conviction and discipline, as well as a deep understanding of value. Buffett is a master of contrarian investing. He is not afraid to be different, willing to stand alone when he believes the market is wrong. This approach has led him to make some of his most successful investments, allowing him to capitalize on market dislocations and generate significant returns for Berkshire Hathaway shareholders. Contrarian investing is not for the faint of heart. It requires a strong stomach going against the crowd and being willing to be wrong in the short term. However, for those who can master this approach, the rewards can be substantial, leading to outsized returns over the long run. Value investing is another cornerstone of Warren Buffett's investment philosophy. It involves identifying companies that are trading below their intrinsic value. This approach requires careful analysis of a company's financials and demands an understanding of its competitive landscape. It also necessitates a long-term perspective. In today's market environment, value investing can be challenging. Valuations are high across the board. It is difficult to find companies that are trading at a significant discount to their intrinsic value. This is one reason why Buffett has been so cautious in recent years. He is waiting for more attractive opportunities to emerge. Despite the challenges, value investing remains a viable approach. It requires patience and discipline. It means being willing to wait for the right opportunity. It also means being selective. It involves focusing on companies with strong fundamentals and a durable competitive advantage. Market sentiment can be a powerful force. It can drive prices up or down, create bubbles and crashes. Understanding the psychology of market sentiment is essential for any investor. It can help to avoid costly mistakes and also lead to profitable opportunities. When market sentiment is bullish, investors are optimistic and are willing to pay higher prices for assets, which can lead to overvaluation. Conversely, when sentiment turns bearish, investors become fearful and are quick to sell, which can result in undervaluation. Warren Buffett is a master of reading market sentiment. He understands how to exploit it to his advantage. He is not swayed by the crowd. He is willing to buy when others are selling and sell when others are buying. This contrarian approach has served him well over the decades. The future is always uncertain. No one can predict with certainty what will happen in the markets or the economy. However, there are steps that investors can take to prepare for uncertainty. They can learn from the wisdom of Warren Buffett. One key lesson from Buffett is the importance of diversification. By investing in a variety of assets, investors can reduce their risk and protect themselves from the impact of any single event. Another important lesson is the need for patience. Buffett is known for his long-term focus. He does not chase short-term gains. He is willing to wait for the right opportunity to emerge. By following these principles, investors can position themselves to weather any storm, navigate uncertain times with confidence, and achieve their financial goals over the long run. Diversification and a long-term vision are two essential elements of Warren Buffett's investment philosophy. These principles have guided him throughout his career and have helped him to achieve remarkable success. Diversification involves spreading investments across different asset classes, which reduces the risk of any single investment. It protects against losses in one area being offset by gains in another. Buffett has famously said, "Diversification is protection against ignorance." A long-term vision is equally important. Buffett is not interested in short-term market fluctuations. He focuses on the long-term potential of his investments. He is willing to be patient and waits for the right opportunities to emerge. This approach has enabled him to ride out market cycles and achieve consistent growth. Warren Buffett's massive cash reserves have generated much speculation. Some see it as a harbinger of an impending market crash, while others interpret it as a sign of caution in an overvalued market. While no one can predict the future with certainty, Buffett's actions offer valuable lessons for investors. His emphasis on prudence, not panic, is crucial. Building a strong financial foundation through diversification, value investing, and a long-term perspective can help weather market uncertainty. Regardless of whether a crash is imminent or not, adopting Buffett's principles can empower investors to navigate the financial landscape with greater confidence and resilience. The key takeaway is that while Buffett's cash pile may raise eyebrows, it should not be a cause for alarm. Instead, It should serve as a reminder to prioritize sound investment principles and maintain a long-term perspective. In the words of Buffett himself, the most important quality for an investor is temperament, not intellect.